Let's get down and get really serious. Recent political election. What was the theme that came out of the recent election? It was climate change. So it's amazing how this wasn't, it's been around for a long time, but it's amazing how it's now really crept into our psyche, crept into everything we do. So to take us through some of these very interesting challenges, Leah Willis from the Australian Ethical Fund. Massive fund, again a big growing fund. And we've got Dr. Stuart Palmer as well. Please come on stage. So Leah's been in the industry way too long to tell us about. BT, Rothschilds, IWF, you name them. So seen a host of things. So have a Q&A and a discussion on those sort of things we need to know about in the ethical world. So responding to climate change. Over to you.
Thanks, Mike. Thank you. I have been around way too long. Thanks, great introduction. Thanks, Mike.
But only because you started at 5, Leah.
Yeah, thanks. Good morning, and I know you've had a pretty heavy day, and why on earth am I standing up here at a managed accounts conference talking about climate? It certainly is the most pervasive thing in our society today, and too right that Mike spoke about the link to the election and the Teal sort of takeover that we saw recently. Climate is the most urgent issue in society, but the most important thing is investors are actually concerned as well, and there's demand to do something about that, and we're seeing a wave of money move into responsible investing. But it isn't easy, right? It's complex. These are complex considerations. We can stand here all day and debate the merits of fossil fuels versus additional lithium mining versus the steel that goes into wind turbines, and there's a whole host of issues. And I'm not the expert, which is why I'm joined by Dr. Stuart Palmer today, who is our head of ethical research and has a team of analysts that consider these complex issues. And we've been doing this now in our portfolios for over 35 years. I have no doubt that you and your clients will all have different views on this. And in fact, there's a famous thing in presentation skills which is called neuro-linguistic programming. When I stand up in front of you, you all have some kind of built-up belief, some kind of perception on what I'm about to present about. And that's no different when you go into a conversation with clients. So we know today that only 7% of the conversations around responsible investing or ESG investing are led by advisors. They're mostly client-led conversations. So why is that? It's because you may not know as much as your client. You may get into a complex sort of conversation and debate about what's important to them. What do you know about climate versus what they have in terms of their perceived ideas? And then you may not have all the answers, and you may not have a solution to be able to offer them. And so that stops you from having maybe a proactive conversation or having more conversations. One of the things about NLP is shelving those perceptions when you go into a conversation. And so today is all about that. It's about me just giving you a quick introduction about the context of why are we talking about climate? Why is it so important that advisors engage in climate as a conversation piece with clients? And then I'm going to hand over to our expert, Dr. Stuart Palmer, to take you through some of the considerations from a portfolio perspective, because you as advisors have a fiduciary duty to make sure that your clients are financially secure, but you have an enormous opportunity as well to respond to this growing era of responsible investing, and in particular, the demand that investors have to take action against climate, and how do you actually consider that when you go to construct a portfolio. So with that, yes, I have got the right clicker. So with that, I'll just quickly give you the context of why are we sitting here talking about climate at a managed funds conference. Responsible investing now makes up over 40% of Australia's professionally managed assets in Australia, and it's actually been growing as a segment much faster than sort of the ordinary or mainstream or non-responsible options in the marketplace, 15 times the rate of growth of the overall market. In that latest RIA report, which is the Responsible Investing Association of Australia, they benchmark the responsible investment assets in Australia each year. Why is this occurring? It's because investors fundamentally want to make a change. It's also the fact that we know as investors, as a financial community, that we can't continue to act like we've been acting. We can't continue to invest with no thought of the impact on society, on the planet, on people and on animals. And investors are moving this way. Investors actually want to have an impact, and you saw that through the election. With a lack of leadership here in Australia, investors have been moving towards responsible or ethical investments to take action on issues such as climate change, but also things like human rights and animal welfare. How do investors feel? We've done an investment trends survey for the first time last year. I will give you a teaser. We have the investment trends survey. It's literally on the printing blocks as we speak. It's been done. All the results are out. It will go to trade press next week. And so you will have a brand new report, which each year provides a pulse check, I guess, on what investors are thinking, what the demand is, what their concerns are, but also how advisors are responding. But this was last year's report, and we saw that 33% of investors already self-select that they're actually investing with some kind of ESG overlay within their portfolios. Interesting for you as advisors is 45% said that they intended to do so or were interested in looking at options in the next 12 months. That's almost 8 in 10 investors that are either investing this way or have an intention or interest in responsible investing. In that report, it also said that next wave of investors were more likely to go to advisors to get guidance around this because there's so many labels, there's so much complexity, we haven't made it easy for investors. Whenever an investor finds an area challenging, we know also from various investment trends reports that they will seek advice. Where they don't understand the labels or the products or they find things confusing or they can't invest directly with confidence, they will come to you for help. What were their major concerns? 71% of investors actually said that they would buy or sell investments, so their investment decision making in the next 12 months would be based on the environment out of all of the E, S and G factors. And then you'll see on this chart that the 3 biggest concerns are all climate related. The issues they noted that they were interested in or concerned about was renewable energy, reducing carbon emissions and also climate change itself and having an impact on that or preventing it. So as you see, climate is in the minds of most investors in Australia today. Then for the quantitative part of your brains, you're all advisors, you all work in finance, that's all well and good. The qualitative, an investor says, I want to take action, I want to have the conversation. What about from a portfolio or an investment perspective? There was quite a lot of action in responsible investing in the responsible investing landscape last year, but also particularly around climate. We had COP26, we had the IPCC reports, but one in particular was the IEA, the International Energy Agency, came out with a report to say that they, and sorry, I should put the context here, that they are the long-term defender of the oil and gas industry or the energy sector. They came out and said that they didn't see any need for any further investment apart from what was already approved in terms of fossil fuel infrastructure moving forward, that we would not make the transition if there was continued capex going into that infrastructure. And that in fact the energy sector needed to transition more quickly. In fact, they also said in that report that there was going to be required over $4 trillion per annum in US dollars every year to be able to reach that net zero emissions target by 2050. For you, that's the potential of risks and stranded assets in portfolios if people or stocks or companies don't transition quickly enough. But there's also the opportunity of new infrastructure, new investment and new opportunities coming to market. But buyer beware, not all green is good. You will have to take an active approach in portfolio construction and selection. Not all green companies will make it to the listed market and not all will have sustainable business models, and you will have to pick through the winners and losers. So there will be greenwashing, there'll be mispricing, and there'll be valuation bubbles that you'll need to contend with as this massive transition, particularly here in Australia, transitions and I guess fundamentally changes some of Australia's leading companies, sectors, but also impacts many communities in Australia. That's why it's important for you to be thinking about and talking about climate. And at that point, I will hand over to Stuart to take you through how we think about climate and how we're evolving our thinking, particularly given the massive transition that we're going to have to undertake in our portfolios.
Thanks very much, Leah. So I'm going to get into the climate issue very, very soon, but let's just start stepping back and say something about ethical investing, responsible investing more generally can be a really difficult area, I know, for anyone to navigate, even those of us sort of operating in the responsible investment bubble. There's lots of labels, ESG, investing, impact, sustainable investing. So, how do you? These aren't precisely defined technical terms. The way to think about it, we think, is think about three key areas. Whatever strategy you're looking at with that sort of label, with that sort of perspective. Firstly, and looking at this in a climate context, the question, where's the capital going, where is it not going, where's it being targeted? So in a climate context, you're probably going to be looking at things like, is it going into the expansion of the fossil fuel sector, or is that something you're looking to avoid? How much is going into the renewable sector? The expansion of our electricity grid, making it more flexible so we can avoid some of the challenges that we're dealing with now. The second key area, engagement, advocacy, and again, a topical area with recent events at AGL withdrawing their demerger proposal. A lot of active investors engaging with the company and the board, wanting to see how companies are or are not aligning their future strategy with a transition which limits warming in accordance with global objectives like the Paris Climate Agreement objectives. Thirdly, sort of is the measurement reporting area. Clients are typically coming to responsible investing with two objectives. Absolutely, they want the secure financial returns that is sort of a base level of expectation, but they're also wanting to make a difference. They're concerned about climate change, so they're looking to see how the portfolios that are being put together by their managers are or not addressing that issue. So we're seeing increasing transparency about the characteristics of portfolios from a climate perspective, and these are a few of the metrics that we and others are reporting: the carbon intensity compared to the benchmark, how much is going into renewables compared to a market benchmark, and also more broadly how the companies in portfolios are contributing towards achievement of the Sustainable Development Goals, which cover a range of responsible investing issues which go well beyond climate, and I'll come back to them shortly. But let's get into the issue, the climate challenge, but also the climate opportunity. Climate change is bringing, on the investment front, many of those challenges, many of those opportunities. The latest risk report from the World Economic Forum tells us that the biggest social and economic risks we face this decade are related to climate change. So they're risks of not taking action to reduce emissions, biodiversity loss, natural resource crises. And these aren't simply future risks. Later in the decade, the next decade, warming above pre-industrial levels globally is already over 1 degree, and it's been rising rapidly during the last century. You can see the trend there. In Australia, actually, the rise has been close to 1.5%. And we're already living with the effects of that warming, with more frequent and more severe storms, floods, droughts and fires. This graph is taken from the latest climate assessment reports of the Intergovernmental Panel on Climate Change, the IPCC. So these reports are the work of hundreds of scientists who are actually going through thousands of different scientific papers and reporting what we know from those papers about climate change and also the things we're still uncertain about. So they're looking at things like the causes, the extent of climate change, the physical impacts of climate change on people, animals, the environment, the economic impacts of those changes, and the pathways which we have for limiting climate change through technological shifts in our energy, transport, food and buildings. So how will the physical world change? Rainfall's a good example. Some parts of the world are going to get more rain, some will get less, and those rainfall changes will be greater depending on how much warming we experience. So parts of Australia will be 10% wetter, parts will be 10% drier, and depending on the degree of warming, there will be 20 to 30% less rainfall in some of our key agricultural areas like the West Australian wheat belt. And rainfall, it's not just about flood and drought risk, it also affects bushfire risk, things like disease risk. So higher and lower rainfall will affect not only where we grow food, but also where and how we live, where and how we work. And these are just shifts in average rainfall. With temperature increase, we get more extremes, more volatility of weather. In Australia, Eastern Australia, we can actually expect to see lower average rainfall with higher warming. You might be surprised to hear, but yeah, the past summer has made it abundantly clear to us here that particular years will still bring extremes of rain and flooding. and we can expect these extreme rain and heat, storm and fire events to become more extreme and more frequent over the coming decade and decades. So this now experience, present experience of climate change impacts is somewhat belatedly shifting government and also a greater number of companies to act more urgently to limit the extent of warming, to decarbonise our economy more rapidly. But even without that strong climate policy, we've already seen massive low carbon innovation and investment, which has dramatically reduced the costs and accelerated the take-up of low emissions technologies. So things like PV solar, wind power and batteries for electric vehicles. Surpassing all those expectations about prices coming down sort of more gradually over time. There's been a real price collapse, price drop, which is hugely encouraging. So partly that's because companies and investors have seen the inevitable climate-driven shift away from high emissions energy and transport, for example, but partly it's because these are seen as and are simply safer and cleaner technologies. So alongside the IPCC, Leah's mentioned the IEA. I won't recap that beyond saying, they're saying no new coal mines, no new oil and gas beyond that, which is already on the books. And on the investment opportunity side, they're forecasting from 1 trillion, going from the current level of 1 trillion up to 4 trillion per annum, needing to be spent in the clean energy space to achieve net zero by 2050, which is the goal to align with the globally agreed Paris climate goals to limit warming to 2 degrees and to 1.5 degrees. So they're talking about an unparalleled clean energy investment boom over the coming decade. As Leah's mentioned, that's really interesting hearing that come from the IEA, because they have long been an establishment defender of the fossil fuels sector. So when they're painting that transformation away from fossil fuels, governments, companies certainly pay attention. And I'll talk a lot about, we'll continue to talk a lot about the energy sector because it is crucial to decarbonisation, but we're going to see transition and transformation right across the economy. So this graph is from the latest IPCC report, which identifies over 40 categories of decarbonisation opportunity across energy, across agriculture, forestry, buildings, transport and efficiency technologies which lower demand for energy and for materials. So more production of electric vehicles, of course, but also ammonia and hydrogen-powered ships, zero-emission steel produced using hydrogen from renewables, concrete in our buildings and infrastructure which absorbs carbon, and machines which directly capture CO2 out of the air. And supporting all these changes, there are going to be fundamental changes in demand for different minerals. That IEA scenario getting us to net zero by 2050, which I've mentioned, sees annual demand for decarbonisation minerals like lithium, graphite, copper and nickel increasing by 5 times over the period 2020 out to 2050. So these are the materials, the minerals, which are essential to re-engineering industrial processes, transport, to allow electricity to replace other hard to decarbonise sources of energy. And this decarbonisation is going to be shaped by just more than emissions, carbon, climate considerations. There is strong competition between different decarbonisation technologies across the different sectors I've mentioned. The winners, we think, are going to be those which are, on the one hand, certainly able to reduce emissions, but also are able to help address other local and global environmental and social challenges. So challenges like the Sustainable Development Goals, the sexy SDG icons up there on the screen, 17 goals agreed by global governments a few years ago, identifying priority areas for global action to address crucial social and environmental challenges by 2030. So alongside tackling climate change, the SDGs include goals to secure access to food, water and healthcare for people who currently lack good access to those things, to reduce inequalities, to support decent work and sustainable growth, to safeguard biodiversity, to promote peace, justice and strong institutions. So yeah, some of the decarbonisation opportunities coming along will be positively aligned with achievement of those goals. Others will carry higher risk of actually obstructing the achievement of those goals. So we can develop wind turbines in the Western Sahara, in Northern Africa, which we're seeing happening at great pace. That can reduce energy emissions, but it can also help the Moroccan government infringe the human rights of indigenous communities there. Electric vehicles, of course, give us great low emissions transport, but they may be manufactured, they are being manufactured in most cases using cobalt mined using child labour. And so the different dimensions of global need, be they emissions reduction, be they reducing inequality, forced labour, modern slavery, are going to actually increase the investment opportunity for companies and technologies which can positively address a number of these dimensions of impact. So, battery manufacturer, for example, is going to do better if it's able to reduce the efficiency of its battery technology. If it needs less cobalt in its batteries, that's going to be a positive. Also, if it's doing positive things to eliminate modern slavery in its cobalt supply chain. But fair to say that all these dimensions of impact identified by the SDGs and beyond the SDGs are increasing complexity for companies, but particularly for investors, when we often have limited information about whether and how companies really are addressing these issues. Thankfully, positively, we are seeing much greater disclosure by companies about their ESG practices and impacts, about how they may be reducing emissions and contributing towards achievement of the SDGs. But it's fair to say this wave of new company reporting is of very variable quality. More companies are talking a pretty good climate game, but the challenge for investors is working out which companies are actually walking that talk. And in Australia, to take an example, I guess, of where we're at, in one area we've moved on from the coal wars to the gas wars, the gas debate. On the one hand, we hear that we can look forward to a massive gas and LNG boom in Australia as gas plays an important role as a climate transition fuel. On the other hand, we have folks like the IEA, the International Energy Agency, telling us gas investment and use actually needs to start falling over the current decade if we're going to get to net zero by 2050. And I just want to be clear, this isn't a debate about whether we will continue to use oil and gas and coal for that matter for many years to come as we hopefully in an accelerated fashion build out more renewables, more energy storage, expand our transmission grids to be more flexible. It's clear that we're going to continue to use fossil fuels for some time to come. The debate is about the speed of the transition. It's about what new gas projects are and are not aligned with that transition, which limits warming to 2 and to 1.5 degrees. And of course, I can't leave gas without talking about the current geopolitical situation, which is obviously complicating things further, disrupting European gas supply, seeing massive spikes in energy prices. But just to state, I think the obvious, gas supply disruption and gas price rises happening today don't magically underwrite an investment return on new long-term gas and LNG projects and infrastructure. There are alternatives to gas. 2021 research by Carbon Tracker looked at the cost of electricity from newly developed wind and solar, comparing it to the marginal cost of electricity from existing gas generation. And across Europe and the USA, new wind and solar are cheaper than existing gas. And that analysis was before the recent price increases. And alongside wind and solar, we have green hydrogen on the rise, hydrogen fuel produced using renewable energy as an alternative to gas. The current disruption of energy markets has only increased the steady stream of Australian and global announcements about new hydrogen projects for production of new electrolyzers to produce hydrogen from water and renewable electricity, for hydrogen hubs, for hydrogen pipeline projects. And this week, the European energy company HH2E announced investment of €1 billion in a German green hydrogen plant which will use offshore and onshore wind as well as solar to produce that hydrogen. Now that, that I guess level of scrutiny that I bring to gas is not to say that, on the other hand, the scale of future hydrogen energy use is super clear. This slide shows some very different growth scenarios for hydrogen. Hydrogen, we think, will play a role in Australia, an important role in Australian and global decarbonisation, but the size of that role will depend on the different ways we end up using hydrogen fuel. So the stronger demand scenarios down the bottom there on the screen will play out where hydrogen is adopted widely in transport, in steel making, and for industrial and home heating. The relatively lower demand scenarios are expected if we do a better job of electrifying industry and transport, so we're able to meet most of our energy needs from clean electricity, and we don't end up needing hydrogen for things like heating and transport. So this uncertainty creates obviously huge uncertainty for future hydrogen demand, but when you're looking at investment in the sector, the uncertainty, complexity is compounded further by competition between the different ways we have of producing hydrogen. So we can produce hydrogen using electrolyzers and renewable energy. We think that over time that will be cheaper than blue or brown hydrogen made from fossil fuels, but that will require a big scale up in renewables and electrolyzers, and yeah, we're seeing capital shifting to fund that scale up. So let me start to wind up with something other than the energy sector, the food sector. Food production contributes between about a quarter and a third of global emissions, and that food footprint will grow as more and more people adopt a Western style diet if current trends continue. There are big differences in the emissions of different sources of protein and nutrition. Per gram of protein, red meat is on average over 20 times more emissions intensive than plant-based sources of protein like nuts, soy and grains. And obviously agriculture has always been a complex sector for investors. It's now more complicated. It's always been challenging because of production uncertainty due to factors like weather variability and potential land degradation, and now we have greater weather variability, risk of drought and flood increasing with climate change, with temperature rise. But climate change is also creating opportunities for farmers, for innovation in farming practices to improve their carbon efficiency and sustainability, for generation of additional income from carbon sequestration through land and soil regeneration, and for adjusting their land use to take advantage of increasing demand for lower emissions sources of nutrition. And I mean, food's an interesting sector because it raises interesting questions about the flexibility of our consumption habits as we head off to lunch in a second. Many of the opportunities for decarbonisation aren't going to change our day-to-day much. I mean, it will for people in affected sectors, obviously, and that's an important consideration. But for most of us, green steel is still steel. Our lights are going to shine the same with electricity from renewables or fossil fuel, and electric cars are still cars. So it is interesting to think about some of the other changes to our world and lives, which will be more personal. And food and diets, it's a hot and button topic often. So up there, a nutritionally complete plant-based food powder isn't going to excite most people. And many people also react negatively to plant-based meat, to the prospect of lab-grown or cultured meat. But it is important to think about potential climate-driven changes to our diet, to day-to-day living that might be on the table in the coming decade. As well as building our homes using different building materials, we may build smaller houses. As well as different cars, we may use alternative forms of transport. We may use less transport altogether. And beyond changes to our lifestyles, we may need changes to our news and social media, to the quality of our public debate, changes to strengthen our democracies. So to finish up, there is a lot of uncertainty about how we will decarbonise our economy. There's not one single decarbonisation story or pathway. The sorts of changes I've spoken about could translate into huge shifts in our lives, our society and our economies, and huge shifts in the prospects the different sectors, different geographies and companies we're going to want to invest in, and those we're going to want to stay away from. To achieve the best climate and investment outcomes, we are definitely going to need rigorous financial and impact analysis of the wave of investment, decarbonisation, investment opportunities which are coming our way. I'll leave it there.
As Leah is coming to the stage, I should say that Australian Ethical have generously agreed to be the sponsors for the ESG and Responsible Investing Awards as part of the IMAP Managed Account Awards this year. It's the first time we've introduced this category. And as somebody who was up at 10:30 last night reading some of the submissions, I can tell you there are some very impressive approaches to implementing these types of issues into portfolios through managed accounts. So, Leah.
Thanks so much, Toby. Did you want to see if there's any questions from the floor as a first starting point?
Well, no, you get the questions prize, Carl.
Sorry, no. Discounting all the other elements of ethical investing in terms of slavery and all the other stuff, but just concentrating on carbon. The climate change is predicated on the fact that carbon dioxide is a problem and we need to get it down. Talk to me about Ian Plimer, who is a geologist and someone that's well-versed in this stuff, who tells us that we're at net zero just now because we sequester double what we produce. Tell me what you think about that.
So the proposition is that across the globe we're sequestering as much as we produce?
Double.
Double, yeah.
Yes.
Yeah, I'm not familiar with that particular claim. Listen, in our process, we follow a range of academic sources, but I've mentioned the IPCC reports, again, tens of thousands of scientific papers which they review and develop the best scientific understanding of are temperatures going up and what's driving them. So I guess that proposition is inconsistent with what we're understanding from those scientific reports.
Hi, I was just wondering, how do you balance the need to invest in mining for things like lithium to actually get the benefits of solar? So as an ESG, do you go, well, I can sort of do mining or I can't do mining because it's hurting the land, but the extraction of what I'm mining as in the lithium is going to help with the battery to create long-term sustainability?
Yeah. So, I mean, there are different approaches to the way you can manage the footprint, the harms of an activity and the positives. The way we look at the mining sector, it's very challenging because of its impacts not only on the environment, but also pollution, often not just carbon pollution, but also the impact on affected communities. So, we do invest in lithium because we see the huge increase in production required to get to that greater electrification of our economy. Lots of technologies, but yeah, particularly battery storage. But we haven't traditionally invested, for example, in iron ore. Steel, we need the steel to make wind turbines. But we don't see massive shifts of capital needed to grow steel production. We see steel being used for lots of unnecessary purposes. There's a reasonable level of recycling. There could be more recycling. There could be more reuse. So yeah, we're focusing on those minerals like lithium, like cobalt, rare earths, where we see that real spike in production needed, where we think, okay, let's target our capital to those areas. And when we're looking at specific companies, we'll absolutely look at how they're operating. So Orocobre, we do currently invest in, but for many years we didn't. We liked the lithium, but we weren't satisfied with the way they were managing impacts on Indigenous people in their mines in northern Argentina. We got a level of comfort with that, so they got our tick and we invested.
Given it technically wouldn't cost the governments anything, why aren't we seeing governments mandate rooftop solar and batteries on every new house that's built, like in the same way they do for water tanks?
Yeah, listen, I think broadly, you can think about there are different ways we can deal with this climate problem, and obviously if we've got companies and governments doing things at the same time, that makes the transition much more orderly, much more efficient. And if you're a government, I guess you've got choices. Can we just regulate, prescribe certain things like compulsory rooftop solar for new builds? Or you can put in place market mechanisms, and we think you need to do both. So, not very popular, I guess, for many years, but we think its time will come. Carbon pricing, you can call it a carbon tax, whatever. You need to price in what we're trying to reduce. So let the market at least start to operate in a way which prices in that negative externality. I guess in terms of being more prescriptive, those sort of regulatory approaches, I think the challenge with rooftop solar at the moment is what we're experiencing right now is, we've got, at different times, we've actually got lots of additional renewable supply. We can't actually get it to end users because our transmission grid hasn't been upgraded. AEMO obviously taken some drastic action, the last day in the operation of the market have been, painting the roadmap for how we need to upgrade that transmission grid to allow rooftop solar, new existing and new rooftop solar, to maximise the benefit from it.
Other questions? No, Leah.
No other questions from the floor? So how much time have we got left, Toby?
That's about it.
Yeah. Yeah, I know. So I think we'll let you get back to it. But thank you for the opportunity to present today. I know it is a complex and scary and challenging area. And I don't ever, say that I know as much as anyone else on this subject. So thank you very much, Stuart, for joining us today. We know it's a complex area. Please reach out to us at any point in time. We have been navigating these sorts of issues for over 35 years now in terms of our ethical charter and the way we invest. We have lots of information. We're very open and very transparent about how we think about issues and giving you as much support as possible as you go into these conversations. I will say next week, hot off the press, will be the new investment trends report with lots of key takeouts for you around how investors are feeling and thinking about issues like this, but also sort of, I guess, what advisors are thinking in this space as well. And certainly we'll continue to produce as much support and as much material as we can to help you through these.
Thank you. Thank you.